Hi there. Today we are going to see financial system. In this lesson, we will discuss financial system, major financial intermediaries, financial markets, financial instruments, financial institutions. What is financial environment? Financial environment is equal to financial system. So we can say financial environment is the financial system in which firms operate. Here firms mean corporate institutions, stock or share market, commercial bank, specialized bank, leasing companies or microfinance company or treasury and so on. Financial system carries out the very important financial intermediation function of borrowing from surplus unit and lending to deficit unit. Financial system consists of financial markets, instruments, institutions and infrastructure. Now we will see components of financial system in Sri Lanka. The first components of financial system in Sri Lanka is Central Bank of Sri Lanka. Central Bank of Sri Lanka is an apex institution in Sri Lanka which regulates all the financial institutions and financial companies and so on. Second one, markets. Basically, it consists of two basic things. First one is capital market, second one is money market. Third one, financial institution. Fourth, financial instruments. Fifth, financial infrastructure. Finally, we will see regulations. The role of financial system. First role, it provides a mechanism by which funds can be transferred from those with surplus funds to those who wish to borrow. Second one, it acts as an intermediary between surplus and deficit. Now we will see the flow of funds. This is the model of financial environment. It shows actors or elements of the financial environment and how this funds flows from surplus unit to deficit unit. Here you can see there are some savers. Savers or lenders. Savers means people or institutions saving their financial resources rather than spending. Here, persons spending less than their revenue. They are called surplus unit. If the savers desire to earn or multiply their savings, they should become lenders. In the open financial economy, lenders may be household, business firms, government, foreigners. And also, there are some group called borrowers. Borrowers are deficit unit. It means they need money for their consumption purpose or business purpose. Financial markets links these lenders and borrowers. Lenders brings funds to borrowers. This is called direct finance. Reciprocally, borrowers repay capital gain. Return means dividend or any other surplus things to lenders. Another important actor in financial system is financial intermediaries. Banks, finance company, microfinance, so on comes under the financial intermediaries. Lenders bring their surplus funds to financial intermediary in terms of savings account, fixed deposit, call deposit. At the same time, banks, other financial institutions lend this money to people, those who need funds for consumption or businesses. In return, borrowers, so this is called indirect finance. In return, borrowers repay principal and interest to financial intermediaries. Financial intermediaries repay principal and interest to lenders. What is financial intermediaries? Financial intermediaries are individuals or institutions which brings borrowers and lenders funds together to trade. The financial intermediaries support in arranging financial transactions between surplus unit and deficit units. Generally, bank as the main financial intermediary involving most financing activities. Now we will see types of financial intermediaries. First one, commercial bank. The commercial banks are major suppliers of short-term and medium-term loans to business for various purposes. It accepts time deposits and demand deposits. It provides these funds as loans. Second one, investment company. It includes mutual funds and real estate investment trust. Pool funds from many savers and invest in various types of assets. Third one, investment bankers. Next, pension funds. Fifth, insurance companies. Six, finance companies. And seven, brokers. What is financial markets? Financial markets include any place or system that provides buyers and sellers the means to trade financial instruments, including bonds, equities, the various international currencies and derivatives. Financial markets facilitate the interaction between those who need capital with those who have the capital to invest. In addition to making it possible to raise capital, financial markets allows participants to transfer risk and promote commerce. We will see components in financial market. The first one, equity market or capital market. Second one, money market. Third one, foreign exchange market. Fourth one, government security market. Fifth one, private debt security market. Equity market, it means capital market, consists of two broad categories. First one is primary market, second one is money market. What is money market? Money market is the market for the short-term securities having maturity less than 1 year. Let's say interbank call money market, treasury market, commercial paper market, interbank foreign exchange market comes under the money market. Second one, capital market. Capital market is a market for long-term securities having maturity greater than 1 year. It includes treasury bond market, corporate bond market, equity market. Capital market can be divided as primary market and secondary. Primary markets. The primary market is the part of the capital market that deals with the issuance and sales of equity-backed securities to investors directly by the issuers, invested by securities that were never traded before. Primary markets create long-term instruments through which corporate entities raise funds from the capital market. It is also known as new issue market. In a primary market, companies, governments or public sector institutions can raise funds through bond issues and corporation can raise capital through the sales of new stock through an initial public offering. Secondary market. The secondary market is where investors buy and sell securities they already own. It is what most people typically think of as the stock market. Those stocks are also sold on the primary market when they are first issued. Here, stock market refer share markets. Now we will see financial instruments. Financial instruments can be defined as a claim to the payment of for sum of money at some future dates. The basic characteristics of financial instruments, it includes risk. Second, liquidity, real value certainty, terms of maturity, currency denominations, divisibility, and We will see financial instruments available in Sri Lanka. In the money market, treasury bills, repurchase, reverse repurchase agreement, commercial paper, bank acceptance. In capital market, common stock, preferred stock, corporate bond, treasury bonds, Sri Lankan development bonds, rupees loans, mutual funds, deposits, whole life insurance policies, nations building. Financial institutions. Financial institution is a company engaged in the business of dealing with financial and monetary transactions such as deposits, loans, investment and currency exchange. In Sri Lanka, there are a number of financial institutions rendering services to the household and business. First one, commercial bank, licensed commercial bank. Second, licensed specialized banks. Third one, licensed finance companies, registered finance leasing establishment, authorized primary dealers, authorized money brokering companies, and licensed microfinance institutions.